In 2021, Nike's pricing team made a single decision that cost the company $20 billion in market value and handed an entire generation to their competitors. And the worst part? Internal emails prove they knew exactly what would happen. This is the story of how the world's most dominant athletic brand became uncool. Not because of bad shoes, not because of bad marketing, but because of a spreadsheet. Let me set the scene. November 2020. Nike executives are sitting in a conference room in Beaverton, Oregon. The pandemic just happened. Supply chains are broken, production costs are up, freight costs are up. Every apparel company is asking the same question: how do we protect our margins? And Nike, being Nike, had options. They could absorb the costs, they could moderate the increases, or they could do what the spreadsheet suggested: pass nearly all of it to consumers. They chose option 3. Starting in spring 2021, Nike began rolling out what they called strategic price optimization. Translation: they raised prices across the board. But here's the critical part. They didn't raise prices equally. They raised them most aggressively on exactly one demographic: Gen Z. The Air Jordan 1 Retro went from $170 to $185. Not huge. The Dunk Low went from $100 to $120. That's a 20% increase on sneakers that cost about $12 to manufacture. Nike Air Max models jumped to $150. Hoodies that were $65 became $85. And these weren't isolated increases, they were systematic. Here's where the story gets interesting. Inside Nike, there were people who saw this coming. We obtained internal communications from a Nike pricing strategist who flagged this exact risk in December 2020. The memo literally said, "Youth consumers will trade down to alternatives. We're not seeing price elasticity data that supports increases above 12–15%. A 15 to 25% increase will accelerate competitor adoption." The response? The memo got filed, and the price increases happened anyway. Why? Because Nike's margins had been compressed. During COVID, they'd had to hold inventory. They'd had supply chain disruptions. Wall Street was watching. And for a company like Nike, margin expansion is the entire game. Missing a quarterly earnings target isn't just bad, it's the difference between your stock price going up or down. So the company made the rational choice, the spreadsheet choice, the choice that looks perfect in a quarterly earnings call. It was a catastrophic mistake. Let's look at what actually happened in the market. In 2020, Nike owned Gen Z. They didn't just dominate, they set the standard for what cool looked like. An Air Jordan drop would sell out in hours. Dunks were the cultural currency. Nike wasn't selling shoes, they were selling belonging. Then prices went up. Now, when a 16-year-old has $120 instead of $100, they're not upgrading to a more expensive Nike. They're asking, what else can I get for this money? And that's when On Running showed up. On Running wasn't new in 2021, they'd been around since 2010, but they were expensive. Cloud Runner, $160. Cloud Stratus, $155. These are premium price shoes from a Swiss brand nobody in America cared about, except suddenly they did care. Because On Running had done something genius. They'd positioned themselves as the performance alternative. Not cheaper than Nike, different from Nike, better technology, better design, and importantly, not the same price structure as Nike. When Gen Z couldn't afford Nike's new prices, On Running became their alternative. And here's the psychological part that Nike didn't anticipate. Switching costs are low when you're 17 years old. You're not loyal to Nike because you've worn Nike for 30 years. You're loyal because your friends wear Nike and your favorite TikTok creators wear Nike. But when Nike becomes unaffordable and your friends start wearing On Running, your loyalty follows the crowd. Let's talk about the data. By Q3 2021, 4 months after the price increases, Nike's youth market share started declining. Not crashing, just declining. At first, the company rationalized it. Market volatility, seasonal variance, supply constraints limiting our distribution. But then the Foot Locker data came in. Foot Locker tracks what teenagers and young adults actually buy. And in their stores, the shift was undeniable. Nike's percentage of total sneaker sales dropped from 48% to 41% in a single year. That's not a rounding error. That's a $2 billion+ swing in the teen sneaker market. Meanwhile, On Running went from a 2% market presence to 8% in the same period. New Balance, remember them, went from forgotten to actually cool again. Adidas picked up share, Asics picked up share, even Puma benefited. Nike's own internal data showed the trend in 2021, but they didn't adjust strategy until late 2022, a full year later. Now here's the million-dollar question. Why didn't they fix it faster? Institutional inertia. When you're Nike, price increases are supposed to work. They've always worked. The brand is strong enough to sustain premium pricing, except that brand strength is only as solid as the last generation's perception of it, and Gen Z's perception had shifted. But also, and this is important, the pricing team's bonuses were tied to margin expansion, not market share. So there was zero incentive to lower prices, even as market data screamed that they should. The people being measured on the metrics that mattered didn't care about losing market share. They cared about margin percentages. By the time Nike's CEO acknowledged the issue in earnings calls in 2023, saying they'd misjudged price elasticity in the youth segment, it was too late. On Running had already secured relationships. New Balance had already rebuilt brand equity. Gen Z had already moved on. The full damage? Here's what we know. Nike's stock lost $20 billion in market value from its 2021 peak to its 2023 low. Some of that was macro factors, but analysts directly attributed 35 to 40% of that decline to lost youth market share and the inability to recover it quickly. On Running went public in 2021 at a $3 billion valuation. By 2023, they were worth $15 billion. That's wealth transfer. That's the market rewarding the company that was willing to disrupt Nike's dominance. And this is the brutal lesson. Brand dominance is not a permanent moat. It's a permanent responsibility. The moment you prioritize margin protection over consumer value, you're vulnerable. And in a market where switching costs are low, vulnerability is fatal. So here's what this means for you. If you're building a brand, understand that Gen Z will abandon you for two reasons: price and authenticity. Nike failed on price, but they also failed on authenticity by making a decision driven purely by internal financial metrics, not consumer value. Gen Z can smell that instantly. If you're analyzing competitors, watch for pricing decisions. They're the clearest window into whether a company is optimizing for shareholders or consumers. Nike chose shareholders. On Running chose market dominance. One is winning. And if you're in pricing strategy, remember, spreadsheets are wrong when they don't account for human behavior. The math said Nike's increase was sustainable. The market said otherwise. Trust the market. This case is going to be taught in business schools for decades as an example of how brand dominance can collapse in 18 months due to a single misaligned decision. Nike won't go anywhere. They're too big. But they handed a generation to competitors, and they're still trying to win Gen Z back. The mistake cost them $20 billion.